Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, welcome. I'm like, all right. Man, trying to get ready for this show today has been, wow, Paul Winkler, Investor Coaching. Yeah, it has been.
What's the show we're doing?
Disheveled.
What's going on? I'm going to say it's sunspots, Paul.
Sunspots?
Yeah, I'm going with sunspots. Anytime there's just some unexplained plethora of technical problems, I just go to sunspots. That's my default.
At least we could get some northern lights out of this thing.
Maybe it's the eclipse coming up. We're getting ready for the eclipse.
I'm thinking anything but what we have been through.
You can blame it on me.
Angry Dan.
I showed up.
No, it's the plates in his head throws off all the electronics.
It's Angry Dan. Danny.
Paulie.
Good to see you, brother.
Always good to see you.
Always good. We don't get this privilege very often.
I'm sorry about that. I wish I could make it more often. I'll try my best.
Yeah, do that because I want to hear what Angry Dan is up to today. What has happened over in your office that has gotten you worked up so far this year? It's early in the year, but I know you get worked up over when you see client portfolios and things that people bring in. So the point being, these are things that are happening in a lot of people's portfolios. They don't even know it.
Exactly.
And you should be angry about it, but you probably don't know to be angry about it. So what we have is a guy that gets angry on
their
your
behalf.
Yes. So tell us.
He's the enforcer for our office.
Yeah, you have hit the nail on the head, as they say. So you realize after working with me and doing it for 15 years, in general, I just get angry on the overall ignorance of the academics and that everybody outside of us pretty much just doesn't even pay attention.
And there are some academics that are perfectly fine and great, but there are a lot of them that are bought and paid for by the insurance industry and so on and so forth. That don't necessarily put out things that are fine.
I wrote an article on academics versus advertising, based just what you were talking about. So, but we had one. James and I worked closely together with Evan in the Cool Springs office, and had a guy.
James out in Dixon office.
Correct.
Yeah.
Correct. Mm-hmm. Good. Always say Dixon.
I know. I thought I'm good boy. I'm a good boy.
We had a person come in, and they were through the conversation. You know how our conversations go. We talk about the academics and Dr. Markowitz, Nobel Prize winning.
Gene Fama.
Dr. Fama's on diversification works, asset allocation. Yeah. And he goes, I'm using the Markowitz stuff.
So a client says this?
Yeah.
Okay.
Yes.
All right. Oh, really?
But like most clients, as you just stated, if we were Japanese, if we lived in Japan, we'd have all Japan. If we lived in Germany, we'd have Germany. And so he lives here. So what do you think he has?
So a person believes that they're actually using the academic research in their investment portfolio. And it's not unlike, it's not unlike what we used to, I remember when the Brinson Hood and Biebauer stuff came out.
Oh,
yes.
94% of your returns or your portfolio is driven by asset allocation, 91.5% in another study. And the other 6% or 8.5% are stock picking and market timing. And that's how we can enhance, quote unquote, is what we were taught to tell people.
Yep.
We weren't, as brokers, we weren't taught to use that research properly.
Yeah, my phrase that I was taught was asset allocation only gets you so far, and then we have to pick the right funds to pick up that last 10%.
Oh,
that's how I was
really
taught
good.
when that study came out.
That's really good for all the wrong reasons.
Oh, yeah.
I mean, at least you guys were taught that. When I came in on the dark side, it was, here's what we have in the box. This is what you can sell people. And of course, it was, I don't remember when I first learned about small caps. Maybe my 6th year in the business when I went out on my own and said.
Well, you see small caps in the portfolios, but they are such a minute part of the portfolio, they may as well be there.
Well,
is what my experience in looking at people's portfolios. But anyway.
Well, you do not like us to mention certain people's names, but one of our founding fathers is who I worked for. And
go ahead, mention names. I don't care.
Old John Hancock.
Okay.
And
not
they're one
not
of
the
ones,
person, mind you, but the company.
No, I worked with John.
We're old, but not that
I
old.
was with Joe Biden, and
I knew Abraham Lincoln, and you're no Abraham Lincoln.
but we actually have it in that same study you were talking about in our PowerPoint, about how small caps work. But John Hancock's one of those ones we list in the PowerPoint that doesn't have a small cap fund, along with a couple other well-known companies.
American funds.
Yeah.
They got one that's called small cap, but it's actually mid cap.
Yeah. So they don't even have one. So I guess that's why I was ignorant, because they didn't even think it was important, even though that study is how old on the 3-factor model?
3-factor Markowitz.
So basically that was 82.
Yeah.
I think
Markowitz was 91 and 93.
Yeah.
Brinson Hood.
Yeah. So like I said, we learned Markowitz, but we used the spin. But I started in 98, and there was no talk of this 3-factor model. It's sales, not no advertising.
Yeah.
We can use that brand name. It's a pretty powerful brand name, but no academics involved.
Well, and I think you bring up a really good point right there, Dan, because a lot of times when people have their money with big companies, and they just assume they wouldn't be that big unless they're doing stuff right.
Right.
Well, they are doing something right.
They're good at sales.
They're good at selling.
Yeah.
Yeah, but what happens so often is, like, you have a fund company with 1,300 mutual funds, and you go, well, why do they have that many mutual funds if they really knew what was going to happen?
Right.
Why do they have? Why is it that you have 9, 10, 11, 12 different mutual funds investing in one area of the market?
Right.
And it's because one of those funds out of 12 is going to do better than the other ones, and you will market that one and say, hey, this is really, really great. But yeah, that is the frustration. And then you'll have the other thing that I see that frustrates me. I guess I'm the one that's angry today.
That's what we call empathy, Paul.
It's empathy. Yes, I'm empathizing with all of you. So what gets me is where they will have mutual funds that are investing, stock picking, and market timing, but they'll also have funds that are holding, buying, and hanging on to areas of the market, and they're not engaging in that. And then they'll have funds that have, like target date funds and things like that, where they'll have funds that are not stock picking and market timing, but they are market timing between those funds.
Yeah.
Which is really fun when they do that. That's really exciting. But that's the frustration. But anyway, you had a client. So the client thought that they were following academic principles. They thought they were following Nobel Prize winning. And then what did you see?
Once we did the X-ray, we showed them that they, in fact, were not, properly asset allocated, diversified. But going back to that example you just talked about, where people have 10, 20 large cap growth funds, those same companies also have passive funds, so pick a lane. Does this work or does this work?
And if you don't know what he's talking about, stock picking, market time, what you're doing, you're assuming that the stocks are mispriced and you're trying to buy stocks for less than what they're really worth. And then when they go up to what they're really worth, that's how you make money. That is a myth, that's how you make money. It's the assumption that you can find. Now, can you get lucky and have that happen? Yeah, but you don't ever attribute luck to to skill and prudence. So in my humble opinion. So you look at that and you say, okay, so if I'm combining the belief that that doesn't work with the belief that it does work, I'm having cognitive.
It's like going to two very different churches at the same time.
Yeah, that's what I use a lot of time. Is use religion as an example.
Cognitive dissonance.
Yes. Yeah. So, I've lost my thought there.
But you're basically what you were saying is that you had a situation where they had all of these different funds, and some of them were active and some weren't active. But the other problem that you run into is that you're talking about an area of the market where there are a limited number of companies. So all these different mutual funds own the same exact stocks, and you miss out on diversification, which nobody would argue is a tenet of investing.
Right. And so what I was going to say is what we use is what you taught me. Is there anybody who can consistently and predictably pick winners? The statistics are overwhelming, 70+% of the time. They can't. Nobody can, right?
No.
Because nobody knows where you and I are going for dinner, right?
Right.
And we're not going to the same place. Most people know that.
Right.
You eat healthy and I don't.
well, it's you have taste vary, but trends vary. I mean, you look back in a few years and you look at the styles that just people were wearing, completely different. Then you have all of a sudden, I'm just my mind's going off.
Bell
to
bottoms are back in.
Well, but but my mind's going to with Apple and their new the
new
Vision,
headset.
the new Vision, and you go, well, who knows if somebody's going to come out with even a better version. There are companies that are trying to work on even better versions of that particular thing. But it's interesting. Who's going to win?
I have to share this. This was this morning when I was going through some stuff. There's I'll say tech influencer. That's maybe not the right term, but his name's Brian Solis, and he does a lot of blogging and all that Facebook posting and stuff in that space. Mm-hmm. And he had a photograph of two. These were two men at the 25-ish, 30-ish, sitting at a coffee table, and the caption was "No cell phones," but they both had on that headset, and so they were sitting
Apple
at
Vision?
the table, and the Apple Vision, but they weren't on their cell phones, but they just
right.
They still weren't talking to each other.
You got $3,500 extra dollars and
$7,000 of hardware
can
sitting
be
at that
tuned
coffee
out
table
from humanity, and it's fascinating. Who on earth knows where that's going to all lead, but I think that is interesting. What that particular product that they've come out. If you haven't seen the videos out there, folks, check it out at Apple Vision. You basically, it's like these people are gesticulating in front of them. They have, they're swiping things. They're doing what you'd normally do on a pad, but they're doing it in the middle of the air, and they can see each other through the glasses. But a lot of the talk is that people just don't like looking silly, having a bunch of, having goggles on and walking around, just kind of weird. But I think that, from a standpoint, I wonder if there's going to be some point a backlash, a psychological backlash, because kids are recognizing that they don't know how to connect with each other. And, I was having my son sent me a video, and it was talking about dopamine hits, trying to get more dopamine and how do you do it. And he was talking about how you do this is partly you get involved in a project. And let's say it's a mundane project, a work project or something like that. One of the things that you do is you stop that project, but you don't go to your phone and start swiping and reading emails and going to social media and all of that. Because what happens is you get a bigger dopamine hit from that, and then you won't go back to your productive work. So what you would be better off doing is go take a walk. And I was thinking about it, that's exactly what I do. That's exactly what I did. He said, stare at a stinking blank wall. It would be better because you got to come down from the dopamine hit and then go back to the work, which gives you the dopamine hit again, which is the feel good, chemical in your bloodstream. And that is the idea, is to do anything to get back. But you look at how people are not engaging with each other, and then the depression, the anxiety, and, you have people having a real challenge in communicating with each other. I've been actually going through some really, really interesting stuff lately, listening to some case studies on how people have lost the ability to communicate and the negative impact it's having on them and the level of anxiety because they get into social situations and they're just, they're freezing up and they don't know how to handle it.
So that reminds me, Paul, way back when. So technology and like Evan thinks as things go. But you remember way back when you had to pay 10 cents for a text over whatever your little limit was?
Oh, yeah.
I do.
No, I think you had so many that you could have, but I don't remember.
Well, it's because my son's 38, so it was when he was 13.
Okay.
25 years ago.
Okay.
And my son and he could text with blindfolds on, because he was Muslim married. But he was doing like 4,000 texts a month.
Oh, my goodness.
To his girlfriend.
Oh, my goodness.
Who he's in school with.
Yeah.
And I'm going like, why don't you just talk to her?
And save the $400.
And he says, sometimes, Dad, we just don't want to talk to each other. But you sent her 4,000 text messages. So that was kind of caveman to where it's evolving now, like you said, to where we're going to all walk. Well, we're not, because I'm not. Walk around with these things on.
Right.
And
right.
Yeah.
Yeah. So anyway, Listening to the we got a lot of really good stuff we got to cover. There's so much stuff to cover that I want to jump into some things. I had a situation that I would love to hear your feedback on. A lady actually invested in something. We got a phone call. She invested in something, and very common investment. And the situation that came up was one that she inherited this asset.
Uh-huh.
And what was fascinating is you can be in a situation where something you inherit actually ends up being a bit of a burden. I mean, that's literally what it is. So
Wow.
I'll talk about that in just a second, because it has to do with distributions from retirement accounts later on assets that you inherit. So we'll get into that in just a second. You're listening to the Investor Coaching Show. Paul Winkler, along with Evan Barnard, Dan Hill. We'll be back. Hey guys, if you want specific advice for your unique situation, schedule a free 15-minute phone chat with one of our trusted advisors by going to paulwinkler.com/call. We don't sell any products, and our advisors don't make any commissions, so this isn't a sales call. We have a coaching process that helps you understand investing and relax about money. Don't put blind trust in anyone with your financial assets. We want to partner with you in the process so you know what you're doing and why. We manage assets on a fee-only basis, which means that when you do well, we do well, which aligns our interests with yours from the start. We also bring you into the financial planning process that gives you a clear plan so you can find the freedom to pursue your purpose. All our advisors are degreed planners too, with years of experience. So schedule a free 15-minute phone call with an advisor by going to paulwinkler.com/call. All right, back here on the Investor Coaching Show, Paul Winkler, Dan Hill, Evan Barnard, talking money and investing. CFPs, both of them, certified financial planners, and way more than that because they're studyaholics like we are. We all are around here. So it got a situation, guys.
Lay it on me.
Client inherits 2 real estate investment trusts.
Uh-oh.
We've talked about that for quite a while, you know, and we saw a lot of them.
And currently unlisted, I'm guessing?
Yeah.
Okay.
Yeah, you got it. Not publicly traded. Had to file for the beneficiary distribution to set up a beneficiary IRA.
Uh-huh.
So what happened is that, you know, try to get the money out, and one company just flat out denied, would not repurchase the shares because she has to take required minimum distributions. You know, so you got, you know, the 10-year rule, right?
Right.
You got to take your required minimum distributions.
Yes.
And you've got to be able to liquidate something to pay those taxes,
Yes.
right? Because you've got an asset, and that asset, you have to figure out the value of it and pay taxes on the distribution. So you have the 10-year rule where you got to have it distributed over a 10-year period. Second company has sent a special circumstances distribution. Well, isn't that special? The person that first bought it passed away,
Right.
and now the inheritor is not the person that bought it. So as a company, it would be the really good thing to do to buy it for full value, whatever it's listed on the statement as being worth. Don't you think that would be a good thing to do?
Or the unit price that it was purchased for.
Yeah, I mean, that would be the admirable thing to do. That would be, I think, you know, as far as ethical way of handling things, it seems to me. No, they said they're going to repurchase shares for 40 cents on the dollar.
Wow.
They're not going to repurchase it for the value of it. They'll repurchase it for 40 cents on the dollar. So they'll give her the money from the distribution, 40 cents on the dollar, so that she can pay her taxes on the distribution because it's required minimum distribution. What do you guys think of that one?
And that was the issuing company?
The issuer.
Gosh. Wow.
Yeah. So word to the wise. I mean, you look at that and go, what are you going to do? Well, I can only surmise that you have to go, what do I think that this is worth to calculate the required distribution?
Right.
Right? You know, so what do you think it's worth to calculate? You know, so you come up with a value and say, okay, I'm in a 22% tax bracket. So 22% of that value will be what I pay in taxes. And then what you do is hope like heck that at some point in the future, you can get the amount that so if you got a, let's say $10,000, let's just use that as an example, and you're a 22% tax bracket, you pay $2,200 in taxes, and then but you can't liquidate it because you can't get your money back.
Yeah.
On the first one, right? You can at all. You're hoping that you get somewhere near at least $10,000, and hopefully not less than $2,200 what you paid in taxes.
Right.
Back at some point in the future when you are able to liquidate it. I mean, I don't know.
I wonder if they can
I have not run into this situation.
Yeah, that's, I mean, used to, like those things typically sold at a $10 unit value, at least when I was doing it back in the day. Mm-hmm. And of course, the Wild West has gotten wilder since I was on the dark side. But, the value didn't float because it's not a listed property. Now, the buildings would obviously go up and down in value, whatever's inside that trust. But basically, it was a stable share price, and you had whatever promissory dividend. Oh, it's going to pay 6.5. It's going to pay 8. Whatever that was.
And that's how they sell it. Yeah, it's going to pay that.
But until it listed, you didn't, as the investor, you didn't typically see that thing fluctuate much in value until they listed it. Now, I mean, some of the rules changed on the accounting and mark to market, and we won't go down that road too much. But I literally wonder if they can only liquidate at 40% of value, can they recalculate their RMD based on 40% of the value of the account? And so they only have to take out, 1/10 of 40% of the value.
That's a good question. I mean, that to me, it would be at least a little bit of a relief.
Yeah.
But on the first one where you have absolutely no value and that they won't repurchase it at all. But I can't imagine that the IRS is going to say, oh, no value, you don't have to take out anything.
Well,
I don't know how do you figure out what the required distribution is if you can't get any kind of liquidation value on it whatsoever because nobody will repurchase it. Is it a total loss? I don't know. But, as an investor, I'm sure that the person that bought the thing wanted to help somebody
or themselves
at some point in the future, whoever inherits this thing or themselves, if they need to live off this money, and just to watch how this all plays out. And this isn't an isolated situation. I think the point that I want to make is this is not isolated. We see this a lot.
Yeah.
And when we see these types of real estate things, they are sold as a good income producer, as something that's going to kick off 6, 7, as Evan said, 8% income every year. And you're going to be able to live off that in retirement. It's going to be great and it's wonderful. And I cannot tell you how many times that was not what happened.
So being that we haven't been on the dark side for a while, because I use those, goes back to advertising versus academics. Those were the flavor of the month or the year.
Right.
For the reasons you just stated.
Right.
Are they still?
Yeah.
You still seeing those?
Oh, yeah.
Oh, yeah, all the time.
Okay.
Yeah.
So
we see it all the
just
time.
like you said, because we were salesmen and not planners back in that day, until 2008, when they couldn't spit out those dividends because, like you said, the value of the underlying asset in the trust was no longer worth $100 million, $200 million, or whatever it was.
Yeah.
So then the dividends went away also. So you're stuck.
I've routinely seen these things inside people's portfolios when they bring them in, and they don't even know they've got them. That's usually what it is. What they do is they see a value on their statement that they have an asset. So they're not upset about the performance of their portfolio because they don't see
it hasn't fluctuated on the statement.
That's right.
Right. Well, and the other thing, and this could be an entire, another conversation as well, but typically we see those REITs, real estate investment trusts, in the portfolio as kind of a substitute for the stable side of the portfolio, kind of as a substitute for a bond or instead of an annuity, God forbid.
Yeah.
But the issue is, as you're pointing out, you can't use a REIT to rebalance with. And so if we have another COVID quarter where equities are down 30%, you don't have anything on that safe side to rebalance with while things are on sale, you're just stuck.
And that's a good point because a lot of times they're sold as something that's a diversifier.
Yeah.
And that's the point of diversifying is when you have 10% of your money in one and 10% of your money in another asset category, and one does better than the other, you sell the one that did better and buy the one that didn't do as well, and that's rebalancing. That helps offset the risk of the portfolio. And that's the idea. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.